Usually when we talk about walking into a medical clinic, there is this implicit expectation of trust.
Oh, absolutely. It's built in.
Right. It's almost architectural. Like you walk in, you see the waiting room, the receptionist, the framed medical degrees on the
Yeah,
wall.
white coats.
Exactly, the
Yeah.
white coats. And your brain just automatically assumes you are in a place of healing run by
Yeah.
people who have, sworn an oath to put your care first.
Well, it's an environment engineered for reassurance. I mean, we really rely on those visible markers of professionalism to feel safe, especially when we're vulnerable or injured.
But when you step into the world of modern financial crimes, that entire waiting room, the diplomas, it can all be a complete facade.
Yeah, completely fake.
Like we are looking at a diagnostic landscape that is entirely fabricated. And for you listening today, our deep dive is focusing on a recently filed federal indictment from the Southern District of New York.
Filed just recently. Yeah, March 35th, 2026.
Right. And the document is officially titled United States of America v. Zhan Petrosyants, also known as Johnny.
Johnny.
Yeah, Johnny. And I gotta tell you, it reads less like a dry legal filing and way more like a masterclass blueprint for a modern medical heist.
It really does.
So our mission today is to unpack exactly how this operation, allegedly exploited the healthcare system, how they weaponized corporate finance to move the money, and the frankly ingenious legal trap the government has laid to get all those millions back.
And, the scale of what we are analyzing here is just staggering. I mean, the indictment alleges a massive scheme running from at least 2018 all the way through 2023.
5 years.
5 full years of systematically defrauding automobile insurance programs out of millions of dollars.
Right.
And keep in mind, this document represents the government's allegations, so we're examining their claims and the mechanics they outline. But the central target here wasn't just any health insurance. It was specifically the no-fault automobile insurance system.
Okay, let's unpack this because that feels like a very deliberate choice of target. Like, why go after car insurance instead of, I don't know, a massive traditional health insurance provider like Blue Cross or Medicaid?
Well, it really comes down to the friction, or I guess the lack of friction, built into the system itself. New York State uses a no-fault insurance model for car accidents.
Okay, so what does that actually mean in practice?
Basically, the whole point of this system is to reduce litigation and speed up care. Like, if you get into a car crash in New York, it doesn't matter who caused the accident.
Right.
Your own insurance company is legally mandated to pay your medical bills up to a certain threshold, which is usually around $50,000.
So the system is designed to pay out fast without dragging people through like years of court battles just to get their physical therapy covered.
Exactly. And right there, you have a vulnerability. Because the mandate is to process claims quickly and get injured people treated, the threshold for scrutiny is inherently lower.
Lower than traditional health insurance, you mean?
Yeah, traditional insurance might fight you on every single referral, right?
Yeah.
They want pre-authorizations for everything.
Oh, don't I know it?
Right. But the no-fault system prioritizes speed. And that creates a massive low-friction pipeline of cash for, well, anyone who knows how to game the paperwork.
But there has to be some sort of barrier to entry, right? You can't just set up a folding table and start billing insurance companies.
Well, the foundational hurdle to tapping into that pipeline is a specific New York state law regarding medical corporate ownership.
Okay.
To operate a medical clinic in New York, the corporation must actually be owned, operated, and controlled by licensed medical professionals.
Which makes sense.
Yeah, the intent is obvious. I mean, medical decisions should be made by doctors bound by a code of ethics, not by, businessmen trying to maximize quarterly profits.
But the indictment alleges Petrosyants and his co-conspirators simply engineered an illusion to satisfy those regulators.
Yeah, a complete runaround.
Because they didn't have medical licenses themselves, right?
Right. Johnny and his crew were not doctors.
So they went out and recruited purported physicians, psychologists, and neurologists to act as the legal faces of these clinics.
Yeah, the doctors basically put their names on the incorporation papers and hung their licenses on the wall.
Validating the facility on paper,
Yeah.
but behind the scenes, it was the businessmen who were controlling the bank accounts, hiring the staff, dictating the billing, everything.
Exactly. The medical professionals essentially functioned as rented credentials.
Rented credentials? Wow.
Yeah, I mean, the person whose name is actually on the door has virtually zero operational control over the business being conducted under their own license.
You know what this reminds me of? It's identical to those ghost kitchens you see on food delivery apps.
Oh, that's a great analogy.
Right. Like you scroll through your phone and order from what looks like an artisanal independent burger shop. It has its own logo, its own distinct menu.
Yeah, it looks super legit.
But if you drive to the physical address, the burger shop doesn't exist. It's just this massive windowless warehouse in an industrial park, housing a centralized kitchen that pumps out food for like 20 different fake restaurants that only exist as digital storefronts.
That is exactly it. The storefront provides the illusion of specialized, independent care. But behind the curtain, it's a centralized, highly efficient production line.
Only in this scenario, it's a centralized fraud factory generating paperwork instead of burgers?
Right, and the type of paperwork they were generating is where the exploitation of the no-fault system really crystallizes.
How so?
Well, the indictment breaks down the fraudulent billing into three distinct categories: services that were never provided, services that were unnecessary, and services that were excessive.
Okay, billing for a service never provided, that's straightforward, that's just pure fiction.
Right, you bill for a consultation that literally didn't happen.
But the unnecessary and excessive services, that requires a bit more nuance. I mean, why not just fake a broken leg? Why dive into the weeds of unnecessary treatments?
Because a broken bone requires an X-ray. It's binary. You either have a fracture or you don't.
Ah, and objective medical imaging proves it.
Exactly. Fraudsters prefer subjective, invisible injuries, soft tissue damage, whiplash, or psychological trauma from a car crash.
Things you can't just put on a scan.
Right, so if a patient is in a minor fender bender and walks away with just a sore neck, the clinic might bill the no-fault insurance for a whole battery of complex psychological evaluations or, like, entirely unrelated neurological testing.
And the insurance company just sees the standardized billing code for a neurological exam. They don't see the patient whose only complaint was a stiff shoulder.
Exactly. They stretch a legitimate minor need into an illegitimate cash cow. Like if you actually need 3 sessions of physical therapy, they bill the insurance for 20.
To max out the policy.
Yes, the goal is to max out that $50,000 no-fault threshold per patient as quickly as possible using high-value, hard-to-disprove billing codes.
So you have a fake owner running a centralized ghost clinic, maxing out no-fault policies with subjective, untraceable medical services.
That's the setup, yeah.
But here's where it gets really interesting to me, because there has to be a fatal bottleneck in this machine.
Cash flow.
Exactly. Even in a fast-track system like no-fault, insurance companies are still massive bureaucracies. They delay, they audit, they process things in batches.
They don't write checks overnight.
Right. And a multi-million-dollar fraud ring spanning 5 years cannot survive on 6-month IOUs. I mean, they have rent to pay, staff to pay, and doctors to compensate for renting out their licenses.
Yeah, liquidity is the lifeblood of any enterprise, legitimate or otherwise. And this brings us to what I think is the most sophisticated pillar of the whole scheme, the financial mechanism that actually allowed them to scale.
Okay, lay it on us.
To solve their cash flow problem, the indictment states Petrosyants and his crew utilized entities called funding companies.
So they bypassed the wait entirely.
Yes. Instead of sitting around for the insurance company to mail a check, they took their massive stack of pending fraudulent insurance claims and just presented them to third-party financiers.
So they utilized a practice essentially known as medical factoring.
Exactly. They hand over the legal right to collect on those pending insurance claims to the funding company. And in exchange, the funding company gives the clinic an upfront liquid cash payment immediately.
Wait, we need to pause here because the audacity of this step, it changes the entire nature of the crime for me.
It really escalates it.
They're taking bad debt based on entirely fake medical evaluations and selling it to a secondary financial market for instant cash.
Yes.
Are we supposed to believe these massive financial institutions didn't notice they were buying millions of dollars in psychological evaluations for minor fender benders? Like, at what point does a funding company cross a line from a duped victim into a complicit partner showing willful ignorance?
Well, that tension is one of the most complex gray areas in corporate finance and financial law. The indictment doesn't actually explicitly charge the funding companies as co-conspirators here. It just notes them as the vehicle used to obtain the payments.
Interesting. So why do they do it?
The reason funding companies take on this risk, and sometimes maybe fail to look too closely at the underlying paperwork, is the spread. When a funding company buys medical debt, they don't pay dollar for dollar.
Right, they buy it at a steep discount.
Exactly.
It's basically a payday loan or like a pawn shop for corporate debt.
That's a good way to look at it. Let's say the clinic has $100,000 in pending claims. The funding company might buy the rights to those claims for, say, $60,000 in cash today.
Okay.
The funding company takes on all the risk and the administrative burden of fighting the insurance provider. But if they collect the full 100,000, they pocket a massive $40,000 profit.
Oh.
Yeah, the profit margins are so high that the incentive structure kind of discourages overly rigorous due diligence on the medical necessity of the claims.
And for the fraudsters, taking a 40% haircut on the total value doesn't matter because the original product cost them literally nothing to create.
Nothing. It's fake paperwork.
Right. So by taking the $60,000 up front, Johnny can pocket his cut, pay his rent-a-docs, and immediately reinvest the rest to open more ghost clinics.
And this specific step is what transforms a slow, bureaucratic medical billing scam into a highly lucrative, highly liquid criminal machine.
The funding companies provide the oxygen.
Yeah, the financial oxygen required to scale rapidly. They completely insulate the fraudsters from the insurance waiting period.
Which sets up an incredible collision with the U.S. justice system. Because if this operation has been running on the high-octane fuel of instant cash from 2018 to 2023, those millions of dollars have had half a decade to disappear.
Oh, they're long gone from the original accounts.
Right. U.S. Attorney Jay Clayton's signature is on this document, demanding forfeiture of all proceeds derived from the crime. But if you are stealing millions over 5 years, you aren't leaving it sitting in a checking account under your own name.
No, the money is washed, it's spent, or it's moved.
So how does the government ever plan to actually recover those funds?
This is where we examine page 12 of the indictment, detailing the forfeiture demands under count 4.
Okay, page 12.
The government doesn't just ask for the specific dollars stolen. They deploy a legal doctrine known as the substitute assets provision.
Substitute assets provision.
Yeah, and it functions less like a simple penalty and more like a financial contagion.
A financial contagion, meaning once dirty money enters a criminal's orbit, the government's claim can basically infect everything else they own.
Exactly. The law anticipates that sophisticated criminals will launder or hide the proceeds of their crimes. So the substitute assets provisions states that if the government can prove you stole a specific amount, say $10 million,
Okay, 10 million.
and they cannot locate those specific funds due to your actions, they are legally authorized to seize any other property you own up to the value of the stolen amount to satisfy the debt.
Wait, really? So what does this mean for the listener to understand? Like, if the actual stolen money is sitting in an untraceable offshore crypto wallet,
Yeah.
but you own a legally purchased, completely legitimate apartment building in Manhattan, the government doesn't waste time trying to hack the crypto wallet. They just take the apartment building.
You just take the building. The concept of fungibility works against the fraudster here. The debt to the government becomes attached to the individual's total net worth.
That is wild.
It is. And the indictment synthesizes this into 5 specific conditions that trigger this contagion.
5 conditions. Let's hear them.
If the original property meets any of these criteria as a result of the defendant's actions, the substitute assets become fair game.
Okay, let's test the limits of this, because money launderers are incredibly creative.
Sure.
The most obvious move is the offshore account. Like, you wire the stolen millions to a bank in a jurisdiction that notoriously ignores U.S. subpoenas.
Well, that triggers one of the primary conditions placing property beyond the jurisdiction of the court.
Ah, so they anticipate that.
Oh, definitely. The government won't spend 5 years navigating international treaties and fighting extradition battles for the cash. By moving it out of their reach, you automatically authorize them to seize your local domestic assets instead.
Okay, but what if they just bury it domestically? Like, use shell companies and nested trusts to the point where the money is just a ghost.
That falls under the second condition, property that cannot be located upon the exercise of due diligence.
But how does the government prove due diligence? I mean, do they have to show they checked every mattress in the tri-state area?
No. They demonstrate a comprehensive financial investigation, subpoenaing bank records, tracing wire transfers, and identifying the dead ends created by those shell companies.
Right.
Once they establish they have exhausted reasonable investigative avenues and the money remains hidden due to the defendant's obfuscation, the burden shifts.
And the government secures the right to seize other visible assets to settle the balance. Okay, so you can't hide it, and you can't move it overseas. What if I try to wash it through a legitimate business?
Like what?
Let's say I own a thriving chain of laundromats. I take the dirty cash from the ghost clinics and mix it into the daily operating accounts of the laundromats. The dirty money is now paying for detergent, payroll, electricity, alongside clean money from actual customers.
Right. Classic money laundering.
Yeah, it is impossible to say which specific dollar is which at that point.
Well, the law explicitly addresses this through the third condition, commingling, when property has been commingled with other property and cannot be subdivided without difficulty.
The government doesn't have to hire forensic accountants to untangle every single transaction for the next decade.
Nope. The act of mixing the funds triggers the substitute assets provision. They will simply evaluate the total sum of the dirty money and seize the equivalent value from the laundromat business. Or, just seize the business entirely.
Man, they really thought of everything. And what if you try to divest entirely, like give it to your cousin or transfer it to a trust in your children's names just to get it off your personal ledger?
That's the fourth condition, transferred or sold to a third party. The contagion follows the value. You cannot insulate yourself by just giving the proceeds away.
So your cousin loses the money.
Exactly. Furthermore, let's say you take $1 million in stolen cash, buy a fleet of luxury cars, and then total them in a demolition derby so their value absolute tanks.
Okay, weird flex, but sure.
Well, the government doesn't just settle for the scrap metal. The final condition covers property that has substantially diminished in value. They will take the depreciated cars, plus whatever else you own, to ensure the full original value is recovered.
It completely neutralizes the incentive for money laundering.
It really does.
Like, you can execute the perfect wash, creating a maze of transactions so complex that no federal agent will ever trace the original dollars. But if you want to actually enjoy that wealth, if you want to own property, buy a house, or hold any visible assets in your name, the government can seize it all to settle the ledger.
The debt is inescapable. It forces the proceeds of the crime to remain radioactive to the individual.
Radioactive, yeah.
The regulatory framework here is designed to ensure that no amount of accounting gymnastics can separate the criminal from the financial liability of their actions.
This indictment really serves as a complete anatomy of modern fraud. You start with a system designed to protect patients, the medical ownership laws,
Right.
and watch it get completely subverted by the simple act of renting a doctor's signature.
They bypassed the regulatory safeguards to build a centralized billing machine.
Then, they exploited the fast-track nature of no-fault insurance, flooding the zone with subjective, high-value claims for ghost injuries.
Soft tissue damage, psych evils.
Right. And when the bureaucracy of insurance wasn't fast enough, they brought in the funding companies, leveraging corporate medical factoring to turn fake paperwork into instant, liquid capital.
They scaled a localized scam into a highly capitalized financial operation.
Only to ultimately collide with the substitute assets provision, ensuring that every dollar they attempted to launder simply infected the rest of their portfolio, leaving their entire net worth exposed to federal seizure.
And, when you step back and view the entire architecture of this operation, it's vital to recognize the broader impact.
It's not just a victimless crime.
No, this isn't just about outsmarting faceless insurance corporations or playing games with funding companies. The no-fault system exists to ensure that people who experience the trauma of a motor vehicle accident can access immediate health care without financial ruin.
Right, so the millions of dollars drained by these ghost clinics don't just vanish into a spreadsheet. The losses are absorbed and distributed. It directly degrades the system.
Premiums rise for every driver. Legitimate medical claims from actual victims face increased friction, skepticism, and audits because the system is just flooded with fabricated data.
It hurts the people who actually need it.
Exactly. The sheer volume of fraud necessitates stricter barriers to care for the people the system was originally designed to protect.
Which leaves a lingering, somewhat unsettling thought for you listening. We are dissecting a document from March 2026 that outlines a sophisticated, highly liquid network of fake clinics that operated out in the open for 5 straight years.
5 years.
Half a decade of generating millions in claims by simply putting a purported doctor's name on a piece of paper and letting the secondary financial markets handle the cash flow.
Makes you wonder.
It really does. If this single operation could scale to that level before the federal government finally stepped in to dismantle it, how many other ghost clinics are currently operating under the radar in our healthcare system right now?
It's a chilling thought.
The next time you walk into a medical facility and see a name on the door and a license on the wall, it begs the question of who is actually pulling the strings behind the receptionist's desk.
Definitely something to look out for.
It is definitely something to chew on. Thank you for joining us on this exploration today. We love taking these complex documents and finding the mechanisms hidden in the text with you. Keep looking behind the storefronts, keep questioning the systems, and we'll catch you on the next deep dive.